Let me welcome you all to the first policy of this financial year. At a time when the global economy is facing unprecedented challenges, from heightened geopolitical tensions, the conflict in West Asia, for which a temporary ceasefire was announced today, and the disruption in global supply chains. Before the outbreak of the West Asia conflict, India's macroeconomic fundamentals exuded confidence, with buoyant growth and low inflation. Conditions, however, turned adverse in March with the widening of the conflict zone and its intensification. The fundamentals of the Indian economy are on a stronger footing at the current juncture than it was in previous crisis episodes, as well as relative to many other economies, providing it with greater resilience to withstand shocks. Global growth faces increasing downside risks as the sharp rise in energy prices and shortages, some of which we saw a correction today in the prices of energy, and shortages of inputs for various industries have stoked inflation fears and pushed up the geopolitical risk premium in the oil markets. Heightened uncertainty precipitated by the ongoing conflict is weighing on the outlook. Safe haven flows have exerted depreciation pressure on currencies of major economies as the US dollar strengthened, while commodity prices such as of metal and gold have moderated. Financial markets have become more volatile. Equities registered a broad-based correction. Sovereign bond yields, already elevated due to long-run fiscal sustainability concerns, driven by inflation fears, have hardened across major economies. I now come to the decision of the Monetary Policy Committee. The Monetary Policy Committee met on 6th, 7th, and briefly today in the morning of April to deliberate and decide on the policy repo rate. After a detailed assessment of the evolving macroeconomic and financial developments and the outlook, the MPC voted unanimously to keep the policy repo rate unchanged under the liquidity facility at 5.25%. Consequently, the STF rate remains at 5%, and the MSF rate and the bank rate at 5.5%. The MPC also decided to continue with the neutral stance. I shall now briefly state the rationale for these decisions of the MPC. The MPC noted that since the last policy meeting, geopolitical uncertainties have heightened significantly. Headline inflation remains contained and below the target. However, upside risks to the inflation outlook, driven by increased energy prices, pressures, and probable weather disturbances affecting food prices, have increased. Core inflation pressures remain, although supply chain dislocations and the risk of second-round effects render the future inflation trajectory uncertain. The MPC further noted that high-frequency indicators till February of this year suggest the continuation of strong momentum in economic activity. Growth impulses continue to be supported by robust private consumption and investment demand. However, the West Asia conflict is likely to impede this growth. Higher input costs associated with increase in energy prices and international freight and insurance costs, along with supply chain disruptions that could constrain availability of key inputs for downstream sectors, would impair growth. The government has taken several measures targeted at supporting exports and protecting supply chains. This should mitigate the adverse impact of the conflict. The MPC opined that the intensity and the duration of the conflict, as well as the resultant damage to the energy and other infrastructure, add risk to the inflation and growth outlooks. However, the fundamentals of the Indian economy are on a stronger footing, providing it with greater resilience to withstand shocks now than in the past. It also noted that the economy is confronted with a supply shock. It felt, therefore, prudent to wait and watch the changing circumstances and the evolving growth inflation outlook. Accordingly, the MPC voted to keep the policy repo rate unchanged, even as it remains vigilant, closely monitoring incoming information and assessing the balance of risks. The MPC also decided to continue with a neutral stance, retaining the flexibility to respond judiciously to incoming information. Before I provide an assessment of growth and inflation now, let me briefly elucidate on the channels of transmission through which the Indian economy may get impacted by the ongoing conflict. First and foremost, elevated crude oil prices could increase imported inflation and widen the current account deficit. Second, disruptions in energy markets, fertilizers, and other commodities may adversely impact industry, agriculture, and services, reducing domestic output. Third, heightened uncertainty, increased risk aversion, and safe haven demand could impact domestic liquidity conditions, economic activity, consumption, and investment. Fourth, weaker global growth prospects may dampen external demand and reduce remittance flows. Finally, adverse spillovers from global financial markets could tighten domestic financial conditions and raise the cost of borrowing, some of which we have already witnessed. Overall, the initial supply shock can potentially transform into a demand shock over the medium term if the restoration of supply chains is delayed. I now come to the assessment of growth. As per the new GDP series, real GDP growth for last year is estimated at 7.6%. This corroborates the underlying strong momentum in economic activity supported by robust consumption and investment. Amidst supportive policy measures, ongoing structural reforms, and favorable financial conditions. Going forward, elevated energy and other commodity prices, as also shocks to availability of inputs due to disruptions in the Strait of Hormuz, are likely to impact growth this year. The government has, however, been proactive in ensuring supply of inputs across critical sectors to minimize the impact of supply chain disruptions. On the other hand, sustained momentum in services sector, persisting impact of GST rationalization, which was carried out last year, and the healthy balance sheets of financial institutions and corporates should continue to support economic activity. The agricultural sector's prospects are supported by healthy reservoir levels, business expectations remain optimistic, and leading indicators point towards continued resilience in manufacturing and services sectors. Moreover, the government's focus on scaling up domestic manufacturing in several strategic and frontier sectors augurs well for India's ensuing growth trajectory. On the demand side, private consumption this year is expected to be supported by discretionary spending. Rural demand remains robust. It should gain further traction on the back of favorable agricultural conditions and a healthy labor market. Urban consumption is likely to strengthen further, aided by the beneficial impact of GST rationalization and the buoyant services activity. While the government's thrust on infrastructure spending continues, the revival in private sector investment is expected to sustain on the back of high capacity utilization, strong credit growth, and benign financial conditions. On the external front, merchandise exports could be adversely impacted from disruptions to key shipping routes, the concomitant rise in freight and insurance costs, and lower global demand on account of the conflict. However, merchandise exports may benefit from the recent trade agreements, many of which were signed last year, and few of them are now in implementation, and others to become operational hopefully this year, while services exports are expected to remain resilient. Taking all these factors into consideration, real GDP growth for this year is projected at 6.9%, with Q1 at 6.8, Q2 at 6.7, Q3 at 7, and Q4 at 7.2%. Further escalation and wider spread of the conflict, as of now, of course, we have a ceasefire, heightened volatility in global financial markets, and weather-related events, however, weigh on the domestic growth outlook. Risks to the baseline projections are tilted to the downside, with uncertainty remaining elevated due to the ongoing West Asia conflict. Coming to inflation, in January, February, headline inflation continued to remain below target. It was 2.7% and 3.2%, respectively. With food group recording inflation, it was in deflation mode, as you are aware, in the previous 4 months up to December. Inflation in fuel terms was modest, core inflation at 3.7%, and the underlying price pressures are benign, as evident from the much lower core inflation if you exclude precious metals. Turning to the inflation outlook, recent spikes in energy prices due to the conflict have emerged as a risk, although retail prices of petrol and diesel have remained unchanged so far. The pass-through of higher global energy prices has resulted in some price increases in a few other fuel items. Food price outlook remains comfortable in the near term, with a robust Rabi production that we had, adequate reservoir levels which would help agricultural activity, and comfortable buffer stocks of food grains. The likely emergence of El Nino conditions could pose a risk. Considering all these factors, CPI inflation this year is projected at 4.6%, with Q1 at 4, Q2 at 4.4, Q3 at 5.2, and then going down in Q4 to 4.7%. Core projection is projected at 4.4%. We are doing this for the first time, as has been the demand from some quarters. And going forward, we shall continue giving our projections for core inflation too. Excluding precious metals, core inflation is even lower, indicating that underlying inflation pressures are expected to remain contained. The risks are on the upside. I shall now speak about the external sector. Global trade is expected to witness a slowdown in growth during 2026 as compared to 2025. This is due to the lingering tariff-related uncertainties, despite the Supreme Court judgment, ongoing West Asia conflict, and elevated energy prices. India's merchandise exports contracted by 0.2% during the first 2 months of this year on a year-on-year basis. This was a result of export contraction in key markets. Merchandise imports, on the other hand, recorded a double-digit growth of more than 22%. This is largely driven by higher gold imports. As a result, there was a widening of the trade deficit. Expected robustness in services exports and inward remittance receipts during Q4 last year, however, should keep India's current account deficit moderate and within the sustainable level last year. Rising global uncertainties and elevated prices of key energy commodities pose some upside risks to India's current account deficit this year. The recent bilateral and regional trade agreements with major trading partners are expected to boost India's trade and investment opportunities, while at the same time, they will also widen and diversify India's trading partners and integrate India into global value chains. On the external financing front, gross FDI witnessed a strong growth, almost about 20%. Net FDI also showed improvement on a small base of last year. India remains an attractive destination for greenfield FDI projects. FPI to India, driven by outflows, primarily in the equity segment, recorded net outflows of $16.5 billion last year. And even this year, till we have data till April 6, there were outflows of more than $5 billion. Flows under ECB and non-resident deposits too moderated as compared to last year. And as on April 3, for which we have data, latest data till April 3, India's foreign exchange reserves stood at a healthy $697.1 billion. These are adequate in terms of the standard metrics of reserve adequacy, whether one sees it from the perspective of import cover, we have about 11 months, as has been the case for some time, or whether one looks at it from the perspective of external debt. Overall, therefore, India's external sector indicators remain favorable. Nonetheless, elevated global geopolitical, trade, investment uncertainties require a continuous vigil of the evolving developments. Despite stronger macroeconomic fundamentals, the Indian rupee in the last financial year depreciated more than the average in the previous years. In this regard, let me reiterate, I've said it many times, our exchange rate policy remains unchanged. Specifically, intervention in the foreign exchange market is aimed at smoothing excessive and disruptive volatility without targeting any specific level or band of price for the exchange rate. This is consistent with our long-standing policy of exchange rates being market determined. And we in the RBI stand committed to this policy and would judiciously continue to contain excessive or disruptive volatility to ensure that self-fulfilling expectations do not exacerbate currency movements beyond what is warranted by fundamentals. I shall now be speaking on the liquidity and the financial market conditions. System liquidity, as measured by the net position under the LAF, stood at an average daily surplus of 2.3 lakh crore rupees since the last MPC meeting. The Walker since then has traded in the lower half of the corridor, except towards end March, which is an yearly phenomenon. Short-term money market rates, especially those of CPs and CDs, commercial paper and certificates of deposit, they remained elevated. G-Sec yields remained largely range-bound with a softening bias in February. But thereafter, on account of the ongoing conflict, they hardened, as did the global yields, along with the rise in the energy prices. Transmission in the credit market has remained satisfactory. To ensure sufficient liquidity in the banking system, the Reserve Bank proactively undertook durable and transient liquidity measures. Going ahead, we will continue to be proactive and preemptive in liquidity management and ensure sufficient liquidity in the banking system to meet the productive requirements of the economy. As for the financial parameters of the banks and the NBFCs, let me inform all of you that the parameters related to capital adequacy, liquidity, asset quality, and profitability of the scheduled commercial banks continue to remain healthy. Similarly, the system-level parameters of NBFCs too are sound, with adequate capital and improved GNPA ratios. As per the latest available data, credit from all sources, not only bank but also non-bank and others, grew at 14.3% YOY. This is in comparison to the 11.7% growth that was witnessed a year ago. Bank credit growth too maintained its upward trajectory. You are aware it had gone down to about 9% in mid-2025. Moreover, it has remained broad-based. I shall now, as has been the practice, announce some measures related to some additional measures. They relate to ease of doing business, capital adequacy for banks, and market developments for one of the segments. I have three measures for promoting ease of doing business. First, to facilitate better utilization of bank board's time. This has been a request from the banks. We have done a comprehensive review of all our extant instructions, which are spread over various directions and regulations. And we propose to now revise and rationalize the matters which require attention of the board. Hopefully, this will result in the board being able to divert more time on policy matters, leaving operational matters to the management. Second, you would recall that we had recently in 2025 done a detailed exercise to consolidate over 9,000 regulatory instructions into 238 master directions. Now, a similar consolidated exercise has been completed for all our supervisory instructions, and we shall be issuing the consolidated instructions in this regard. Third, to facilitate ease of doing business by MSMEs, we propose to dispense with the requirement of due diligence while onboarding them on to various TREDS platforms. For capital adequacy of banks, there are two measures proposed. First, it is proposed to remove the condition regarding NPA provisioning for inclusion of quarterly profits in their CRAR computation. Second, in view of the developments in prudential framework over the years, it is proposed to dispense with the requirement which was laid down a few years ago to maintain an investment fluctuation reserve as an additional buffer to hedge against depreciation in the value of investments. For further development of the term money market, there is one measure, as I mentioned. We have decided to permit certain additional categories of non-bank entities in this market segment. You would be aware only banks and standalone primary dealers, or SPDs, are today eligible to participate in this market. We are also enhancing the borrowing limit of the standalone primary dealers in the term money market. To conclude, global economic conditions and sentiments have soured after the outbreak of the West Asia conflict. These have adversely impacted the growth inflation outlook. As reiterated before, we shall remain vigilant of the evolving situation and put in place policies that prioritize the best interest of the economy. Thank you, Namaskar, and Jai Hind.
Okay, so that was the word coming in from the top boss of the RBI governor, Mr. Sanjay Malhotra. Just summing up that policy for you, unanimously, the RBI MPC has voted to keep the repo rate steady at 5.25%. The governor also says it felt prudent at this moment to wait and watch for any more supply shocks and then recalibrate and act accordingly in terms of what the rate outlook is going to be. Other than that, neutral stance has been maintained. The STF is at 5%, bank rate and MSF is also at 5.5%. Just very quickly summing up what the inflation and GDP projections are. GDP projection now for FY26, in fact, it has been seen at 7.6% based on the new series compared to the projection of 7.4% earlier, so positive over there. Other than that, for quarter 1 FY27, we're now expecting a GDP growth of 6.8% compared to 6.9% earlier. For quarter 2 FY27, this is where the real pain is being penciled in. We're seeing GDP growth of 6.7% compared to 7% earlier. Quarter 3 seen at 7, quarter 4 at 7.2, overall FY27 GDP growth seen at 6.9%. For inflation projection also, quarter 1 has been maintained at 4% by the RBI, but quarter 2, like I mentioned, the real pain being penciled in. We're now expecting an inflation number of 4.4% compared to 4% earlier. For quarter 3, it's 5.2. For quarter 4, 4.7. FY27 inflation is seen at 4.6. This is something that we're going to be watching out for very keenly. And what's really interesting, a new curveball by the RBI is they're also going to start reporting core CPI projections, which for FY27 for now has been projected to be seen at 4.4%. So in a nutshell, this is what the policy roundup has been so far. Just taking a look at what the market impact has been, 773 points higher yet on the Nifty, with close to 23,900 even as we speak, and the 3.3% uptick that we had seen since the gap up has been maintained. Interestingly, the RBI governor has in detail addressed everything that's happening in terms of energy, the shocks that we're seeing in the energy supply chain, the Strait of Hormuz, the traffic that has been seen. In fact, he started his speech by talking about the ceasefire that was announced earlier this morning by Donald Trump, Israel, as well as Iran to try and clear that traffic from Strait of Hormuz. Donald Trump has said that he is going to be aiding that process as well. So this is going to be very positive. But yes, large precautions and a lot of precautions given by the RBI governor in terms of watching out for macros ahead, for exports, for remittances, for supply chain shocks, as well as what happens to CPI and GDP projections. Let's get in an expert view on everything that we've heard so far. We have Mr. Ramamohan Rao Amara, of the MD of SBI, joining us on the show. Mr. Amara, morning and thanks for your time. First up, give us your first sense on what you have made of this policy outcome. Largely in line with expectation, the repo rate has been kept steady at 5.25%. But talk to us about how you are gauging the cautiousness or the tone of the policy and what's your outlook over there.
Yeah, good morning, and thank you for inviting me to the show. As you rightly commented, I think this is on expected lines. RBI adopted a very cautious approach, and particularly as the data is still emerging, they looked at, of course, the indicators that are there in terms of whatever indicators are available. The MPC also alluded to the threats that are there in terms of supply disruptions, elevated fuel prices, and the potential, the second order and the third order effect on the rest of the industry, if it were to continue, if the war kind of situation were to continue for some more time. I think these were definitely factored. But of course, the MPC statement also alludes to the strong profile of the banking system and the kind of continuous liquidity that is available in the system, which RBI is augmenting continuously on a proactive and preemptive manner. I think for the given situation, when the uncertainties are very, very high, this is the best kind of a decision and a calibrated decision.
Okay, so we're having some problem with Ankur's audio. We'll try and patch him again. But Mr. Amara, now that we've spoken about the tone, the tonality, the outlook, talk to us about the numbers, the projections that have come for inflation as well as GDP. Yes, FY26, the actual number based on the new series, nominally better than what was projected earlier. But what's really concerning is the CPI inflation number that we're expected to see. 4.6% for overall FY27, and in fact, that 40 bips hike for the quarter to FY27 prediction that has just come in. How should one be reading into this?
I think all the kind of taking into account the issues around the elevated fuel prices, availability issues, and the kind of time it will take for locating the alternate supplies and ensuring a complete availability to the industry. I think it is, of course, they did take into account the possible El Nino effect and slightly below the normal kind of rainfall kind of situation being predicted by some of the agencies, weather agencies. I think all these factors have been considered in a kind of estimating a higher inflation.
Hi, Mr. Amara, Ankur this side. I want to understand from you the announcement which has been made regarding the NPA provisioning to support capital adequacy. How much of the benefit it will be there for you and particularly for all banks?
I think we need to see the fine print. I mean, as of now, this is a statement. At least I haven't seen any fine print as to what kind of changes have been proposed under NPA provisioning. So will not be able to comment on the impact as of now.
Okay, so that's the take coming in. Mr. Amara, I'm trying to understand this one statement that's come in from the governor, just trying to understand where he's saying initial supply shock can transform into a demand shock in the near or medium term, and that could impact growth. You have any idea on the quantification? If you could help us with what the impact on growth could be, or any idea what should one be making out of this statement from the governor?
I think, we are already getting some kind of feedback from the operating units as well. As of now, the supply disruptions are impacting some of the clusters in MSME, particularly who are involved in ceramics or glass manufacturing, or even those rice clusters in some of the southern states also, which have exports to the Gulf, etc. I think they did get impacted. This is what the ground level feedback. But if the situation were to continue, then obviously the inflationary pressure will be high, and that will dampen the consumption. And the economy being largely being dependent on consumption, I think it will have a decelerating impact on the dampening effect on the growth. I think that is what I think when the MPC statement alluded to supply shock leading to demand compression over a period of time, if the current situation doesn't get resolved soon.
Right. Mr. Rao, Governor also mentioned about the rupee that it has depreciated almost more than what it would have been in the last few years. And in that, there was an order which was passed by Reserve Bank of India to all the authorized dealers. So I want to understand how much of the impact it is going to have on the bank. And more importantly, he also mentioned about the credit growth in the system, which is more than 14%. So how do you see the situation on the ground and also the impact of the order on the banks?
I think, RBI's stated stance has always been to eliminate the excessive volatility. That again was reiterated today as well. But when they felt like there was excessive volatility or speculative element at maybe a few days back, they perhaps used some unconventional tools to send a very strong message to the market and to dampen that excessive speculation, to stamp out that excessive speculation. And this has desired result. We have already seen rupee appreciating by 2 rupees. From 95 levels, it has come down to 93 and even below 93 today. This has a desirable impact, but all these measures might be like under continuous review at RBI end. Whether they should be continued or not is always subjected to further reviews. Growth-wise, credit growth, I think we have seen. I think a number of banks have also reported a very robust credit growth. And Q4 in any financial year always is you always see a very robust demand. So it was not a surprise that we saw very robust demand in terms of bank credit growth. All other elements, whether it is a remittances or whether it is a overall consumption, etc., as MPC statement alluded to, I think they are at a good position. Even high frequency indicators do indicate like the momentum is continuing and it is robust.
Okay, so that sounds optimistic. We're going to be watching out for how all of these macros pan out as well. Mr. Amara, on that note, we'll let you go. Thanks so much for your time today.
Thank you.
Okay, viewers, then shifting focus, let's keep going with the conversation. We have a whole host of experts who've now joined us on the channel. Mr. R. Gandhi, former Deputy Governor at RBI, joined along with Dr. Sachidanand Shukla, the Group Chief Economist at L. Along with that, we have Ms. Anita Rangan, Chief Economist at RBL Bank, and Ms. Anubhuti Sahai, Head of India Economic Research at Standard Chartered. Good morning and thank you so much for your time. It's a wonderful panel of guests that we have. Mr. Gandhi, let's begin with you. You've heard in detail the policy. Talk to us about your key takeaways, first of all, from the tonality of the policy. It was brief, concise, to the point, and addressed multiple concerns at once. According to you, give us your first sense right off the bat. What are you making of this policy?
Yeah, first of all, thank you for having me here. And the MPC's assessment and the final decisions were all on expected lines. There are no surprise in terms of their assessment or the final action. So that is the first thing. What further information that we can drive out of MPC is the projections for their forecast of both on GDP and inflation. That is where they will likely a discussion is going to be there. I think among people interested, all the stakeholders, how to assimilate those changes vis-a-vis the earlier forecast. That's what a quick reaction. That much what I will tell us. Thank you.
Right. Anubhuti Sahai, I want to come to you. How do you read the tone of Reserve Bank of India Governor today, and particularly when he has made the commentary regarding rupee as well as bond yields? Do you think that in terms of even projections, it was higher than the estimate which market was having?
Yeah, sure. So let me just start with the growth projection. And MPC has projected 6.9% growth for fiscal year 27. We are at 6.4%. So if you compare where the market estimates are versus what the MPC has projected, it will obviously look very optimistic. But we have to consider and remember that the RBI and the MPC, they have a much bigger mandate of stabilizing market sentiments. And a sharp downgrade, which analysts like us can do, is not something which, a knee-jerk downgrade is not something which central banks in general do. So we expected a gradual downgrade in fiscal year 27 growth projections, and that is what MPC has actually delivered. The big thing to note is that even though MPC has given a higher than, like a very optimistic growth projection for fiscal year 27 at 6.9%, they have caveated it by saying that there are downside risks. And in our view, it's pretty justified, given that the situation is still evolving. If this temporary de-escalation turns into a permanent one, then maybe you'll actually see the street estimates moving higher rather than MPC estimates moving lower. On the overall tonality of the MPC statement, again, a very good policy and a balanced view, pretty clear communication from the MPC that they are on a wait and watch mode. They noted upside risks to inflation, downside risks to growth, and also indicated that if there is, they are likely to remain vigilant and contain any excessive volatility in the FX market. So a lot of comfort has been expressed when it comes to the FX levels and bond market levels. But again, reiterating that as a policymaker, as a regulator, besides providing where things are, it's also important for the policymakers to soothe market worries. And this is where this whole narrative was targeted in. And in our view, it was a good policy and a good communication from the MPC.
Policy, concise communication coming in from the MPC. That's the verdict coming in on the tonality of the policy. Let's refocus. Ms. Anita Rangan, let's come to you. Give us your sense on some of the statements that were given by the governor in terms of domestic demand outlook, the remittances that are coming in. So lots has been spoken about the domestic economy. But one line that really stands out is when he said that the supply shock that we're seeing right now could transform into a demand shock if the supply chain transformation doesn't happen in the near future. Could you talk to us about the actual impact? How bad could it get? If you could give us a better picture over here.
Yeah. So when he spoke of supply side shocks, I think primarily we should start from the fuel side shocks. So one, we already understand that fuel supplies, especially from gas, basically natural gas and LPG, has been disrupted. So what that translates into, even as we speak, I mean, we know that so many of the migrant workers in various urban centers have actually started moving back to their rural homes, which would impact actually the construction business. This is a second order impact that we would see in terms of a demand slowdown as well, because they are wage earners, and if they don't get the wages, then the impact will start falling on the rural employment side as well as we speak. And we are actually having an El Nino risk as well. So this is like a multiplier effect. Again, if exports say slow down, and one of the earlier speakers spoke that, rice exports are slowing down, or if the overall, MPC governor also alluded to the fact that export outlook for next year is actually lower because of the global risks, then it means that the export side manufacturing business will see a slowdown, and that will lead to a second order effect on demand slowdown as well. So there are many parts here which can impact, and plus we are actually looking at an inflationary risk where already inflation is expected to be higher, which means that consumption will automatically be lower. So the second order impact is fairly high at this point in time. So that's why we see that, the MPC has actually plastered the entire outlook with a lot of risks. Growth outlook has a downside risk, inflation has an upside risk, external has an upside risk. So there is risk written all over. And he started the policy also by stating there are 5 important transmission channels, and all of that is like risk channels which are very much active. So a ceasefire does not actually translate to an immediate, a complete ceasefire. And let's not forget that rupee is not impacted just by 1 month's impact. There is a capital flow issue, and he also spoke about FDI flows, net FDI flows not being as robust. We've seen last 2 years FDI flows has been slow. FPI flows have also been, it's not only a March problem. FPI flows decline has been a problem in 2025. A ceasefire does not solve the capital problem per se. So that continues to remain, and that will also be an overhang for the economy. That's why I think whatever temporary measures RBI has announced in terms of curbing speculative flows are still temporary. So when that is taken out, what happens then? And for that, we need very strong capital flows, which means there needs to be very strong growth. So if your demand is kind of slowing down, then that actually adds to another layer of problem. So there is still risks, but it's kind of a policy that says that, okay, we are vigilant, we are watchful, but risks are very, very high at this point in time.
All right, point taken. Sachidanand Shukla, I want to come to you. How do you see the projections of Reserve Bank of India vis-a-vis inflation? Again, the governor has clearly highlighted that minus precious metals, the situation is not that bad. Even the projections are a little bit better if you see in the overall tonality. How do you read the inflation targeting of Reserve Bank of India in the current policy?
First of all, let me say that a no surprise policy and in a very, very balanced tone is good news. And the other thing, which is more important, is also let's look at the directionality of the projections that the RBI has come out with. We all know that this is a supply shock. Nobody's sure how long this is going to last, and therefore everybody has really struggled to price in the war premium and the kind of disruptions that might happen. And from that perspective, let's look at the directionality on growth. There is going to be a downward pressure, and on inflation, an upward pressure. From that point of view, I think it is in the right direction. One may quibble with the numbers on a quarterly basis, but I think as far as the core part goes, and which is a very, very good contribution from the RBI, a lot of us economists have been asking or requesting the RBI for that. From that perspective, that is probably a better gauge in terms of price pressures. 4.4 is what they have come out with. And like the governor said, the risks probably are on the upside, which is the right assessment. We may quibble about a couple of quarters, 10, 20 basis for a particular quarter. But I think for the year as a whole, most of us economists are in that 4.6 to 5% range. So I think with El Nino pressures, there are multiple monitorables. We'll have to monitor the weather. We'll also have to monitor how the conflict really gets resolved over time. So I think these are imponderables. And with that in perspective, I think the annual number, FY27 number, which is at 4.6 odd percent, I think is probably right. Maybe 10, 20 basis here or there. But I would put it in that 4.6 to 5% range. And I think the commentary is very, very well balanced. And we will have a lot more to monitor going forward from here.
A lot to monitor as well, and the commentary looks well balanced. Let's take that ahead in terms of what the inflation and GDP outlook is. Anubhuti, give us your view on how achievable or how realistic these numbers are. And also what I want to know is, as and when we start to have more clarity in terms of energy supply, if the war completely de-escalates in the near to medium term, talk to us about if there could be a chance of any change or any modification in these projections that have been given by the RBI for now as we head towards the end of FY27.
So sure, I think, there are two important and two big ifs in your question. One is, when or if the war gets over, there is no clarity on the timeline. And the second important if and how is we have to see the aftermath of the war. There is a possibility that even if the war gets over, energy prices might remain elevated for a much longer period if certain important infrastructure in the energy space are damaged, and if they take time to come back to their pre-March level of operation. So these are two big ifs, and at this point in time, none of us have the crystal ball to answer these questions. Having said that, I think from the MPC's perspective, they have very clearly highlighted downside risks to growth. Usually, if you look at the previous MPC projections, risks for both growth as well as inflation were always flagged as balanced. And what Sachidanand mentioned, the directionality is pretty clear. Given where we stand today, given the high probability that the impact of war on energy prices is likely to be much longer than the timeline of the war itself, there is a possibility that the growth projections are likely to be revised lower as the year progresses, and inflation can be revised higher. But as I mentioned right in the beginning, as analysts, we have more degrees of freedom to downgrade growth forecasts much more sharply in one go, or upgrade or revise our inflation forecast in one go in a much more sharper fashion. As policymaker, as regulator, and their mandate to keep sentiments supported, the downgrade and in the growth forecast and uptick in the inflation forecast by the MPC was expected to be gradual, and that's what they have done. And as the year progresses, and as we get more clarity on both the war timeline as well as the aftermath of the war on the energy prices, I think we can keep on seeing more fine-tuning as the year progresses. But at this juncture, given that our growth forecast is at 6.4%, inflation forecast is at 4.7% without taking into account weather risk, the directionality which RBI has or MPC has indicated, that direction will remain a key monitorable from the market perspective.
Right, Mr. Gandhi, I want to come to you now. As far as the MPR which has been released, I can see that the crude projections for this year has been assumed at $85, which was 75, I guess, earlier. So overall, how do you see the overall plan of central bank dealing with the downside risks of the West Asia crisis? Now, the governor has already given all those highlights in the opening statement as well. When you are dealing with the policy in such a situation, how do you navigate the situation, and what should market take away?
Obviously, the central banks having access to various data points, their model is much larger in terms of parameters that are being watched and fed into the model. So whereas just now, as I mentioned, that the analysts, their own model, they will have a very quick assessment kind of. So that way, because obviously being the part of the policy making hierarchy, they get access to all such parameters. That is one. And two, their research team is also very focused, long-standing credentials in terms of expertise built over the period. So that way, their assessment will always be more sanguine in terms of it is not volatility or their intention to keep the assessment slow. That is not the intention. That model itself brings out that kind of stability. So that is one point. So what you're asking is that based on this, what is the market should think about? How to reassess their own stance, their own actions based on this assessment. That is, of course, each depending upon each entity's risk-taking, risk appetite and risk-taking capacity, they may have a different view on that, and that's a different. But the one thing what everyone should be clearly keeping in mind, that anything going to extreme, policymaker will always come in the way. Just as we have seen in the last 2 weeks when the rupee was quite volatile, and to bring in sense of sanity, the Reserve Bank had to use certain tools which are harsh in normal course. Obviously, sometime when the restoration take place, they will definitely be revisiting that and withdrawing those tools in operation. That's part of course by that way. All right. So that way, market should take cue from the strong message MPC and Governor Reserve Bank is telling, that we are watchful,
right.
We'll be proactive, and we'll be preemptive also. So those are the three things they should always remember.
Okay, appreciate that, and that's positive messaging coming in from the RBI governor. So yes, the street is also taking it with a thumbs up. It's a positive reaction on the street. But Dr. Shukla, as we wrap up this conversation, give us your sense of what is going to be on the RBI's radar next in terms of priority. Is it going to be to balance the CAD, which doesn't look like a very big of an issue right now, is the outlook going to be to tackle the merchandise export number and the slowdown over there? Is the focus going to be on the rupee? Is it going to be a growth versus inflation scenario? What is the outlook here? What do you think they're going to prioritize going ahead?
So I think all of the above, I mean, whatever you mentioned, but let me make a point. Discussions like these, or basically the numbers when we talk about GDP and things like that, the macro numbers or macro shocks obscure the micro impact many a time. And the kind of pain sectors or individual corporates or individuals undergo and the second and third order effects, these are some things that really need to be priced in properly. And most of these discussions or events don't really give enough emphasis to that. So I think we are in for some pain going forward on the growth side. A lot of sectors have been hit. A lot of balance sheets are going to be hit, at least in the Q1. And assuming that the war really ends, even after the 15-day deadline, we probably don't have much to worry about on the war side. I think the backdrop remains very, very uncertain. We have the tariffs. We have the Section 301 investigations going on, the AI-related, fears. Geopolitics is going to remain uncertain, and the balance of payment weakness. So I think, to your point on current account deficit, while we are running lower current account deficits from our past, but financing of these is becoming a much, much bigger problem. So if you look at the FDI numbers, for example, from August onwards, I'm saying the net numbers are actually negative. If you look at portfolio flows, equities was mentioned, and then we have seen big outflows. But even on the bond side, we thought that probably getting into a lot of these bond indices is going to really become a big help. It has not. If you look at the numbers, even there we are seeing outflows at a time when you need these flows the most. So I think we have multiple challenges on the growth side. And then the best part is probably that the starting point of growth is very high. We are around 7-ish, and that's a good place to be in. And we are able, therefore, our ability to actually withstand some of these shocks is higher. But having said that, to my mind, the growth impact is going to be larger, and the RBI will have to focus on that. And not just RBI. The RBI has been very, very active, and it has a toolkit. It has employed its entire toolkit on the rupee and some of the other variables going forward also. But I think it will need a much more holistic approach. We need fiscal policy to kick in. We need broader policy reforms to kick in. And that will probably altogether help alleviate some of the pain for sectors and the micro impact that I mentioned, which is going to be very, very important. And there are multiple things to worry about as we move ahead in this fiscal year.
All right, point taken. Thank you so much joining for this hour. And more importantly, what I can see right now, the MPR has been released by Reserve Bank of India. And important data of projections is coming in from Reserve Bank of India, which I want to tell viewers. First of all, we mentioned about the crude oil. The assumption for 2025 was $70 per barrel. Now that has been revised to 85 for this year, and for next year that has been revised to $75 per barrel. So that is the projection which Reserve Bank of India is seeing on crude front. If you talk about the exchange rate, there is a revision in the projection by Reserve Bank of India. 88 was earlier assumption. Now that has been revised to 94 US dollar per dollar. Apart from that, if you talk about the global growth, yes, Governor did mention about the global growth coming down. Now that has been revised to 2.9% versus 3% earlier, and 3% overall for FY27 versus 3.1% earlier. So with this, it's time for a wrap in this edition of special coverage on monetary policy. Thanks for watching.